Welcome to an update for Federal Milk Marketing Order 33. This is Dr. Lawrence Jones with FARME Institute, and I'm very proud to have this supported by Nobis Agri Science, who is really a leader in the nutritional world. All right, so I'm recording this on June 29th. I get asked almost every day, are we still in a bull market? And I want to try to answer this in a couple different ways. So this is the Class 3 spot market price, since back in December. And so you can see that is really kind of flattened out. We did have this bull run, which is no doubt. We went from, a low of $14 clear up now to 19.30, 19.40. So I just got to ask myself, what is it that drove that bull market? And so to me, there are four things that we need to look at. One is export/demand, lack of replacements, regional feed shortages, and then the big one, I think, is fear. Let's start with exports. So we know whenever there is a significant difference in price between the global trade, which is in green, and our national dairy sales report that's in blue, we have the opportunity to export. And for the first 4 months of the year, we had great opportunities to export. And in fact, in April, we exported probably about a 23 million extra pounds of cheese because we exported about 8.6% of the production, where normally we're 6.9 or somewhere like that. But here's our last global dairy trade auction, and we'll actually have another one this Tuesday. It was down a little bit, and so right now cheddar is at $1.91. Our spot market on Friday was $1.91, so there's like zero opportunity. It takes about 20 cents to get it from here to there. So anytime that it is this close, you're not going to export. Of course, we've had like no ability to export butter in quite a while just because our price has been so strong. Now, whole milk powder came down about 4 cents. That drove the overall world price down to $15.41. Non-fat dry milk on the spot market was $1.18. That's plenty high enough to get it offshore at $1.34. But we'll see that we expect this non-fat dry milk, which is really skim milk powder on the world market, to be dropping this next session. So we may get out of that market again too. Now, if we look at demand, there is no doubt that we have really chipped away at these cheese stocks. And so here is the May overall cheese stocks. It was way off the trend line, which trend line is entirely too strong. You can't grow at 2.6% per year and continue growing. And it was slightly below the seasonally adjusted level. So there's no doubt that we've chipped away at these cheese stocks. And one way that you do that is by increasing demand. Of course, another way is to reduce the production of cheese, which I'm not sure we've actually done. Really, it's hard to look at this data until we get the dairy products report, which we won't get for May for another couple days. But this is the last one that we had for April. And in April, we were actually still making more cheese than is disappearing now. At the same time, USDA came in and readjusted some April numbers, so this may not be true anymore. But as of this report, we were making more cheese. Now, interesting, this says we need 9.38 million cows to meet this demand. So as we look at the slaughter numbers, this year we've down about 255,000, and it's just always a bit lower than we were in a year ago. But you can actually take this data and massage it and make some assumptions and some of these other things. So what I did is in 2023, I come up with a ratio of heifers to cows, or replacements to cows, of 0.78 to 1. Now that's a little bit lower than I would like to see, but it just says that the herd can hold but not grow. In 2024, again, I don't have a lot of data because we don't have the May numbers yet, and we don't have the complete June slaughter numbers yet, but it looks like it is trending down a little bit, and it could be 0.76. So there's no doubt that there is just a shortage of heifers or replacements to keep this herd growing to any great extent. But it actually did come up a little bit this last month. But again, this is just noise. We're at 9,350,000. So again, that previous number was 9,380,000. So we're just about 20,000 cows below what we need to, meet that overall demand. But again, that's within the standard deviation of where USDA is. And we're way off of these numbers that we were up in here. And I actually call that a bit of a sugar high that we had in terms of cow numbers. Talk about regional feed shortages, kind of a big issue down here, Arizona, New Mexico, Texas, Kansas, Oklahoma, all these areas. And they were down in milk, but it's also all tied up in bird flu and lots of different things. It's hard to know why production was down, but that area is particularly down. Idaho is also down a little bit, but again, the biggest area was kind of in the south. If it is just a shortage of feed, that should be rectified here soon, I would think, as new crops come in and we always turn a new cycle over. And the last thing I want to talk about is emotion. And so what I've built here is an emotion index for each month. And all I'm doing is trying to see, as a contract is beginning to settle, is how much does it wiggle around. And so there was a lot of emotion in the market in July and August of last year. And if you remember, that's when prices were really low and then they just rocketed up for a little while and then they settled back in. And also there's been a tremendous amount of emotion right now. To try to explain this to you, I'm going to just show you two different contracts. So here's the December contract. So as it's kind of coming in here, it's nice and settled and, moves very methodically. Here's the May contract. It just was bouncing around. You're up, limit up one day, you're limit down the next. You're up 60 cents, you give it all back up the next day. And so that's what I'm calling that emotion. So we are getting ready to settle June, which will get the class and component numbers next week. And again, when we look at this kind of glide path, we've been in 10 cents for a while, but it got caught up in a limit up day, and so it was up a range of over 50 cents, another one here. So those are the emotions that I'm talking about. And this contract, it was coming in 1850, fell off, ran clear up to 21 and changed, fell back down, and now we're kind of settling in. I've got it about 1987, the trades at 1989, maybe 1990, we're within a couple cents. For class 4, I'm at 2107, the trade's at 2115, so again, not too far off. But what you can kind of bank on right now is butterfat being around 354, protein being around 206, and other solids, 23, 24 cents. And I'm also going to say that prices in June should be about $1 higher than they were in May, and we'll put a capital M in there for May. So when we look at your statistical uniform prices for May, it came in at $19.45, up $1.18. Now I said that it should have been up more like $1.60, but that $19.45 is a relatively strong number compared to what we've had over time. The reason I was off on that is because of the depooling. This plus $1 that I gave in the previous slide assumes a 50-50 ratio of class 3 and class 4. So once you get your depooling check from the co-op, you're probably going to be up that $1.60 that I was talking about. And so you guys are significantly depooling. You have been through, last half of 2023 all the way through. And again, why wouldn't you, when you can take $20.50 and the co-op take it away from your neighbors, so to speak, and then give it back to you in a depooling check. And so anytime there's 75 cents difference there, they're going to depooling. But as I say, what it does is it takes money from everybody and only gives it back to the ones that were depooling. And so what's it look like in the future? Again, I say 75 cents. It looks like you're going to be depooling all the way through here. At one point, we thought that there might not be some depooling in July, but then that class 3 came back down. Because for a little while, class 3 was trading higher than class 4, but these are the closes as of Friday. And so class 4 is significantly over class 3 at this point. And with those last class component numbers, we can actually estimate what it's going to look like for the rest of the year. And this is, again, as of the close on Friday, and right now we're looking about $1.51, 2024 over 2023, and we've been saying $1.50 plus or minus 50 here for quite a while. We got the egg prices on Friday, and that allows us to calculate the DMC. That came in at 10.52 for dairy margin coverage, so that will not trigger a payment at all. The all milk price was at 22. That fat test that we were talking about for the nation was at 4.17, so down 0.07 from last month, but again, very strong. Just to finish this off, corn was 451, up from that 430s that it's been at. Soybean meal has been under 400 for the last 5 months, and then this premium alfalfa hay has just been at 275 here for quite a while. And here is that fat percentage plotted out. It's way above the trend line, which is a 1.1% per year. A little bit lower than we thought it would, given how high the previous month was, but overall just a very strong fat test in the nation. And for order 33, you guys were 0.07 up also, 407 versus 40 for last month. These just have been continuing to have higher highs and higher lows. Protein was pretty well flat. It's hard to change protein, and protein prices have not been really conducive to push it. And so this really has kind of stabilized here, kind of at the levels that we're at. And for May, that was 3.18. So where are we today? So that's the big question. We've talked about where we've been, and maybe big term, where we're going. So this is our spot cheese prices. Again, we had this bull run up, we hit resistance, we came down to support, we hit resistance. And so where are we today? And we've been sideways for about the last week. And I think this is kind of the support price that we've been looking for. And if we can hold this, then it'll be, up from there. And if not, who knows how far it could drop. But I don't anticipate, given all the news for shortage of milk, that's going to be dropping like that at all. And so we look at the last 2.5 weeks of spot cheese. There's a number of things that are very interesting here. Number one, blocks are now higher than barrels on Friday, so that has been rectified because barrels have been leading this bull market for quite a while, but finally in 6 weeks here we got blocks back on top. This has been just a significant fall off on both barrels and blocks, and the question is, what's driving that? There are some speculations that some of these companies like to convert cheese into cash at the end of a quarter. And so you remember that Friday was the end of June and the end of Q2. So has this been kind of just coming down on the fact that some companies wanted to dump, 13 loads here, 11 loads here? For barrels, it was 7 and 7, because it really settled out this last week to be, pretty close to nothing. So again, Monday will tell us the story. If there's nobody and sellers and there's only buyers, then this thing is going to kind of come back up. Whey has just been in a 2-cent trading range, just can't break that 49 cents. So nothing major, and again, no trades. I mean, there hasn't been more than 2 trades all the way through in the last 2.5 weeks. As I said, non-fat dry milk is in a downward trend. That doesn't make sense given this upward movement of global dairy trade, except there's lots of suspicion that that's going to drop here this next Tuesday, which would go along with that. And there are a number of times when non-fat dry milk is going to lead the drop. So we can start seeing the fact that it's coming down, and then global dairy trade, here's another one that it came down, and then the global dairy trade came down next after that. So lots of suspicion that non-fat dry milk prices are dropping. Just kind of finish up with butter here. This has been really in about a 4-cent trading range, if you will. 308 to 312 maybe. There was one down day. But again, we're way below the global dairy trade by 14 cents. This is a time I always like to look at cream multiples. It gives us an idea of what might be happening. And so the cream multiples are 1.35. They're up from where they were just a couple months ago at 1.28. but not crazy high. So they're not, in that 1.5 or something like that that's going to drive this butter price up to 4. Interesting, there is some still distressed milk in the upper Midwest. Spot prices were going from $1.50 under class, up to class prices. Now, a year ago, there was a lot of distressed milk. It was $10, $12 under class, but right now it seems to be more balanced. So let's take all that and kind of put that into a calculation here. So Nate Donnelly from StoneX kind of always comes out with his estimate of cheese price based on how cheese stocks changed. He's kind of moved his estimate now up to $1.85, $1.90. So I went to the class calculator. I put in $1.90 cheese, 50-cent whey, $3.10 butter, $1.20 non-fat dry milk. What pops out is $19.39 class 3 and $21.29 for class 4. Do I think that's where we're going to be long term here? I really don't know, to be honest with you, because we've got to ask the question, is how short is milk and how strong is demand? If milk is really short, like everybody says, there are no cows, there are no replacements, then this thing, is going to run up to 2.10. But if the dairy industry is very resilient and demand is actually dropping a little bit because there's nothing like high prices to cure high prices, then we may be in this $19, $20 range. All right, so let's turn to grains for just a minute, because this was a really down week for corn. It took a beating. They're down $11.50 a ton. Soybean meal actually came down a little bit less, but about $5.88 a ton. So our PE index, which is 8 pounds of cornmeal, 8 pounds of soybean meal, dropped down to the point that it's under $2 a cow right now. So what happened? So basically the grain stocks came in higher than what the trade was expecting, and the acreage for corn came in higher than the estimate was expecting. So that was very, very bearish for corn. Corn was down like 30 cents at one point on Friday. And if we just look at these channels that we have, corn has broken out of that channel. We had that, close to 155, and it broke it. Soybean meal is still kind of in the middle, so it's not had as much damage done to it as what corn has. So again, our PE index is 8 pounds of corn, 8 pounds of soybean meal. And let's just look at, when have we been down to this $2 level? And it's been a while. So if we just look at this $2 off of that 280, that's like 80 cents a cow a day cheaper to feed the cows on a grain basis. So that is highly, highly significant. And if we look at our dairy margins, kind of the same thing. When have we been above 13 and a half? And it's been a long time. And we're in this channel right now. And that's largely due to grains getting a lot cheaper. That always begs the question of, how is the 2024 crop going to look? So the drought has really been beaten back. There is a little bit of short-term drought in the corn area. Now, Michigan looks pretty good, and maybe just a little bit of yellow there, but just not like it was a year ago. And if we look at how the weather is going to be for the next 6 to 10 days with the southwest monsoon, lots of rains up through here, so that should take care of any abnormal dry area that we've got. This high ridge is kind of down here, wiggling back and forth, giving us that higher temperatures in the southeast, but the jet stream is running across the Canadian-US border right now, and so it's just kind of keeping things cooler up there. So I want to thank you for tuning in to this month's report, and I think it's going to be very interesting to see which narrative gets played out in the dairy as to whether we are really, really, really tight on milk, or whether we can more or less get by in that $19.50, $20 kind of number. All right, I'll get you another report next month about the same time after the cold storage.